what is a stock, right? A stock, also known as equity, is a security that represents the ownership of a fraction of a corporation. This entitles the owner of the stock to a portion or a proportion of the company's assets and profits equal to how much stock they own. Units of stocks are called shares, right? So people get stock and shares kind of confused. They're basically the same thing, but it's just that the units of stocks are called shares, right? Stocks are bought and sold predominantly, remember, predominantly, not only, but predominantly on stock exchanges, though there can be private sales as well. And they are the foundation of many individual investors' portfolios. These transactions have to conform to government regulations that are meant to protect investors from fraudulent practices. Historically, they have outperformed most other investments over the long run. So, but that's a key thing to remember, right? Historically, they have outperformed most other investments over the long run, right? So, this shows you that it has a good pedigree and a good history. When you're talking about various different other forms of investment, we know that historically stocks have outperformed most other investments, right? But again, you have to have a good strategy in order to do that. These investments can be purchased from most online stockbrokers. Okay, so what are the key takeaways? Key takeaways is a stock is a form of security that indicates the holder has a proportionate ownership in the issuing corporation, right? So to simplify that, what that essentially means is, say for instance, you have a company, right? You can sell, 50% share ownership or stock in the company. If somebody buys that, that means they have 50% of your company they own, right? Now, not to get too deep into stocks and shares and things like that, but there are various different types of stocks and shares that you can own, right? So you can own some kind of, form of stock in the company that allows you some kind of um, authoritative control in making decisions for the company. And there are some other types of stock that only allows you, ownership of the company, right? So you have ordinary shares and preferential shares and various different shares, right? So just understand that obviously when you own, 50% of the stock in a company, what that typically means is that you can get paid out from the profits of the company, which they call dividends. So dividends is basically a fancy way of saying divided ends, if that makes sense. So it's a divided ends. So basically, we're going to divide up the profit within the company to pay it out, right? So you're basically getting your share, which is where the term shares come from in, stocks and shares, right? So you're getting shared out a proportion of the profits of that company, right? So look at stocks as, a percentage of an ownership of a company, right? So if there's 100%, if a company has 100 shares, each share is basically worth 1% of the company, right? And essentially the value of the company, is based on how well it does and how well it trades and how well it's predicted to do. The more the value of the company increases, obviously each individual percent becomes more valuable because it becomes 1% of a great amount of value of the company, right? So when you're talking about, stocks, you're essentially trading the value of the company, right? So we all could all say that McDonald's is a valuable company, right? If you own 1% of that McDonald's, you know that it's going to be worth 1% of whatever McDonald's is worth, and that's going to be worth a lot of money. If McDonald's, has some kind of scandal, or they start selling, horse meat burgers or something along those lines, things like that will devalue the value of the company. Therefore, the overall value of the company will be less. And therefore, each percentage of the company will be less as a result, meaning each stock will be worth less value, right? So they say corporations issue, in brackets, sell stock to raise funds to operate their business. There are two main types of stock, common and preferred, right? So as I said, there's different types of stock, right? So essentially what corporations do, they sell stock to raise funds to operate their business. So you can have a private company, and then you go through what they call a IPO, which is an initial public offering. So essentially, what you do is you put your company onto the stock market, and what that allows you to do, again, you can sell a proportion of your company and receive money for your proportion that you sold, right? So people often do that is because they want reinvestment into the company. You know, if they sell a portion of the company, they can then take the profits or the proceeds from selling that and put it back into the company to grow the company, right? So stocks are bought and sold predominantly on stock exchanges, though there can be private sales as well, and they are the foundation of nearly every portfolio, right? So essentially, what we do when we trade mostly on public stock exchanges. So these are the stock exchanges that we're talking about that we do our trading on, right? Historically, they have outperformed most other investments in the long run, right? So that's a basic understanding of what stocks are. They're a percentage of a value of a company, right? And the better the company does, or the worse the company does, affects the overall company's value. And the overall value obviously represents each it obviously represents each part of the company. So each part of the company, or each percentage of the company will also move up and down depending on the overall value of the company. All right. So let's go to let me see if I can change. Let me go to this next page. If we go and now look at what is a stock market. Let me pull up again. We're going to stock market definition. This again is on Vistapedia. So we're looking at exactly what is a stock market. So what is the stock market? The stock market broadly refers to the collection of exchanges and other venues where the buying, selling, and issuance of shares of publicly held companies take place, right? So the stock market is a broad term that refers to the collection of stock exchanges. Remember, so there is not one stock market. So they say what is the stock market? There isn't the stock market. There is a collection of markets that we refer to as the stock market, right? So it's a collection of exchanges where you can buy and sell and issue shares of publicly held companies, right? So again, the issuance goes back to what I said, which is the IPO, the initial public offering. And this is where you issue your company to become a public held company, right? This is where you share out your company to be bought and sold in the public. Such financial activities are conducted through institutionalized formal exchanges, where physical or electronic or via over-the-counter (OTC) markets that operate under a defined set of regulations. While both the terms stock market and stock exchange are often used interchangeably, the latter term generally comprises of a subset of the former. If one trades in the stock market, if one trades in the stock market, it means that they can buy or sell shares on one or more of the stock exchanges that are part of the overall stock market. A given country or region may have one or more stock exchanges comprising their stock market. The leading US stock exchanges include the New York Stock Exchange, NYSE, and the NASDAQ. These leading national exchanges, along with several other exchanges operating in the country, form the stock market of the United States, right? So this is telling you that even though we use the term stock market, the stock market is generally an overall term for a collection of the stock exchanges, and there are various different stock exchanges that form the stock market, right? So the key takeaway, stock markets are venues where buyers and sellers meet to exchange equity of shares of public corporations, right? Stock markets are vital components of a free market economy because they enable democratized access to the trading and exchange of capital for investors of all kinds. Remember, again, for investors of all kinds. So this includes us. This is what we want to be. But it's also important because it also includes these major institutions. And why it's important that we have major institutions in there is because we do trend trading. And essentially what trend trading is following these major institutions in terms of following where their money goes. What we want to do is we want to ride off their coattails, off the back of them. Wherever they're pushing the money is that's where we will go. We will follow the trend that they go and they take us as, because we want to go where the money is, right? They perform several functions in the market, including efficient price discovery and efficient dealing, right? So this is an important thing, efficient price discovery. So we use the charts and the markets to understand exactly what price is doing and where the money is. In the United States, the stock market is regulated by the Securities and Exchange Commission, SEC, and the local regulatory bodies. So what we do at Focus on Investing, we not only use the US markets, but we also follow in the UK markets, right? So we don't really delve into any other form of stock markets, simply because, although these other markets have a lot of volatility, they have too much volatility. The thing you have to understand about trading is that if you have no volatility, then the markets don't move. And if you have too much volatility, then what happens is it's unpredictable and uncontrollable, right? So we want just the right amount of volatility, which is controlled, predictable volatility. And therefore, we can build a solid strategy around that in order to make good returns in the market, right? So we go with the UK and the US markets because, in terms of countries or nations, they're very established countries and they have quite a stable economy, stable enough for us to get some kind of predictable outcome. A lot of these smaller economies, they whipsaw back and forth quite often and quite frequent when it comes to, any sort of small little, economic issue. Because of the size of them and the stability of their country, you generally get a lot of volatility from those. All right, so we've covered what is stocks and what the stock market is. Just seeing in the chat. Hello to Shay Star, welcome. So again, as I said before, we don't only cover stocks, we cover Forex and commodities. Well, why do we do that? We do that because we know that, when we're dealing with stock trading and the stock market, you're dealing with, an overall economy. And sometimes the stock market goes down. So when the stock market goes down, what often happens is you will find investors put their money into other areas. So those other areas might be, they might put it into the Forex market or they might put it into commodities. If recently, at the beginning of the year, we know that the markets were down, right? But when the markets were down, the commodity market started booming, right? We saw, uprising and a lot of things like gold, silver, palladium, and all of these different things started rising, right? So this is why it's important not to get too fixated on one type of market. Don't get fixated on the stock market. Don't get fixated on doing Forex. Don't get fixated on doing commodities like buying gold. Don't get fixated on buying cryptocurrency. Don't get fixated on, doing property or any one thing, right? We like to have a broad understanding of how to trade markets because, when one market is down, we can then move to the other one, which might be up, right? We want to have the ability to go to trade any market depending on where the money is. Again, as I said, we're trend traders and the trend we follow is following the money, right? We want to be where the money is, right? So if you don't do that, what ends up happening is when the markets are down in whatever particular, type of market you're trading, you're stuck. You have to wait for the market to turn around. Whereas there might be, market money being made in other forms of markets. But if you don't have the trading and the understanding of how to trade those other markets, you're unable to capitalize on your finances at that time, right? So this is why we trade not only the stock market, we trade the Forex market, and we trade the commodities market, right? So let's take a look at what is Forex exactly. I know when people are getting into trading, a lot of these things might seem a bit, foreign to people, or they don't really understand. Trust me, once you understand how to read a chart, you can, right? Stack mode says diversify, right? You always want to diversify your investments because you don't know what one market is going to do versus the other, right? So once you understand how to do technical analysis, you can understand how to read a chart. You can read a chart for stocks. You can read a chart for Forex. You can read a chart for crypto, and you can read a chart for commodities, right? So let's take a look at what foreign exchange is, right? Of what Forex is, sorry. Let me see if I can share this page with you. So again, we're back at Investopedia. So let me make sure you guys can see this. There we go. So Forex, so Forex, if you don't know, Forex is short for foreign exchange. That's what the FOR is for, and EX is exchange. So foreign exchange. So what is foreign exchange? Forex. Foreign exchange, Forex, or FX for even shorter, is the trading of one currency for another. For example, one can swap the US dollar for the euro. Foreign exchange transactions can take place on the foreign exchange market, also known as the Forex market, right? The Forex market is the largest, most liquid market in the world, with trillions of dollars exchanging hands every day. There is no centralized location. Remember, there is no centralized location. Rather, the Forex market is an electronic network of banks, brokers, institutions, and individual traders, mostly trading through brokers or banks. So remember that there is no centralized location. Rather, it's a network of banks, brokers, and institutions and individual traders, mostly trading through brokers or banks. Key takeaways. Foreign exchange, Forex or FX, is a global market for exchanging national currencies with one another. Foreign exchange venues comprise the largest securities markets in the world by nominal value. So remember this, you're dealing with the largest securities market in the world. So those who don't trade it are missing out on, the largest market, securities market in the world, with trillions of dollars exchanging hands each day. Foreign exchange trading utilizes currency pairs priced in terms of one versus the other. Forwards and futures are another way to participate in the Forex market. So, what is foreign exchange, right? So, people don't really understand this. I know most people, well, I should say most people, but if you've ever been on holiday, you go to exchange your money. So say for instance, you're going from, UK to the US or US to the UK, and you want to exchange dollars for pounds, right? You will go to your, broker, or your foreign exchange broker, or your bureau de change, or bureau de change, if you want to be French. And you'll go and say, I want to change dollars for pounds, or I want to change pounds for dollars. And what they will do is they will tell you what the exchange rate is, right? What they are essentially doing is trading on the Forex market. This is essentially what Forex is. Just like how you change your money to go on holiday or go on vacation, it's the same way that the market works, right? You could essentially trade the Forex market by just literally taking your money and exchanging currencies back and forth, depending on the rise and fall of the different values of each of these currency pairs, right? So again, as stated, Forex is always done in pairs, right? It's always one currency versus the value of the other currency. And generally, it's based on, the economies of the country. If the economy of the country is doing well, then their currency does well, and it will be valued better against, another currency. Versus if the economy goes down, the value of the currency also goes down, and then the value of its currency would decrease in terms of another currency. So remember, because it's done in pairs, it's always relative, right? So your currency could be doing great, But if it's paired against another currency that is doing great, there's not going to be much difference between the two, right? And remember, whenever you're dealing with trading, you're dealing with the volatility. We always want volatility because volatility is movement, right? So we make money from the movement of these charts. If the charts go up or if the charts go down, we can make money. But if it doesn't move, we can't make money, right? So if you have, even though your currency might be performing well, if it's paired against another currency that's performing well, if they're both moving up at the same rate, then there is no difference between the two of them, and therefore there'll be no opportunity in order to make money because there is no movement between the different currencies, right? Conversely, again, if your currency is paired against another super volatile currency, which is a really weak economy, then you could get too much volatility. And then too much volatility isn't good because it's hard for you to control or predict your trade or the outcome of your trade, right? So, remember, Forex is just the exchange of currencies against each other, and they always come in pairs. That's the thing to remember. But also remember, we're saying here that Forex is where it comprises the largest securities market in the world by nominal value, right? So this is why we trade this. Remember, we said that the stock market, traditionally performs the best over a long time, over long term. So you'd want to be in the stock market. So those that only do Forex are missing out on something that traditionally over time performs the best. And those that only do stocks are missing out on the Forex market, which is the largest securities market in the world, right? So this is why we don't get emotional and attached to any particular, type of market or type of trading. Some people build their whole identity around, I'm a Forex trader, or I'm a stock trader, or, this is emotion, and emotion should never come into play when you're talking about investment. Investment should always be something that you're strictly logical about, and then you don't get emotional about things, because your emotion is something that will force you to make bad decisions, right? And the thing that helps you to eliminate your emotions is having a good strategy, right? And again, this goes back to why we use technical analysis rather than fundamental analysis, because fundamental analysis a lot of time is about hearsay, it's about emotion, it's about whether you like the person giving you the information, and all of those things start coming into play, right? Whereas when we're dealing with technical analysis, it doesn't matter who says it or who says what. It's based on what we can physically see and prove on the charts, right? So so this is foreign exchange. So essentially, when we're trading foreign exchange market, we're trading the difference of value between currencies, right? So the last thing we will take a look at to get an understanding of is commodities. So what is a commodity? So let me bring up this. Again, we're back on Investopedia. So Investopedia is good for a basic understanding of like terms and definitions and things like that. Commodity definition. Let me make sure you guys can see this. There we go. All right. So what is a commodity? A commodity is a basic good used in commerce that is interchangeable with other goods of the same type. Commodities are most often used as inputs in the production of goods and services. The quality of a given commodity may differ slightly, but it is essentially uniform across producers. When they are traded on an exchange, commodities must also meet specific minimum standards, also known as a basic grade. Right. So this is giving you a general overview of what commodity. Essentially, it's a basic good used in the production of other goods and services, and they can be traded on exchanges. They can basically be traded on exchanges, right? So this is a bit of a wide overview of what commodity is, but we'll drill down in a minute. So again, what is the key takeaways? A commodity is a basic good used in commerce that is interchangeable with other commodities of the same type. So it's fungible, if you understand what the difference between fungible and non-fungible is. So they would be fungible because they're interchangeable, right? Commodities are often used as inputs in the production of other goods and services, right? So a lot of time when you're dealing with a commodity, you're talking about like raw materials. A lot of things that are mined out of the grounds are referred to as commodities, right? It's an input in the production of a good and services. So it's the thing that you input. So for instance, it might be copper, and you might input, raw copper into the making of, wires for, electricals or things like that. So again, it's the input of the production. So again, dealing with a lot of raw materials. Investors and traders can buy and sell commodities directly in the spot, brackets cash, so spot means cash, market, or via derivatives such as futures and options. So remember, we spoke last week as to what futures and options are. They're just basically different vehicles or different instruments that allow you to trade various different things, right? So don't get confused again by futures and options. They're just different types of instruments that allow you to, in this case, trade commodities, right? So it's telling you here, you can trade commodities directly in the spot or directly trade them for cash, or you can trade them via derivatives or via different instruments like futures and options, right? So again, don't get confused by words. They're just describing different instruments, right? So it's essentially saying you can basically go somewhere and directly buy, these, say for instance, as for example, we said copper. You can go somewhere and directly buy copper and hold on to it. Or you can trade them via instruments. That means you don't directly touch the tangible material itself. So it's like for gold, a lot of people actually buy gold coins. You can literally go and buy gold coins and then later on the line go and sell them directly. So that's one form of investing and trading. Or you can do it via electronically and just kind of buy an instrument that represents the gold rather than touching the actual gold. You know, so it kind of reflects, if we talk about what we was doing with Forex, where you're actually trading cash to invest. It's the difference between actually touching and trading the cash versus, maybe going electronically on your screen and you have what is representing the cash rather than touching the actual cash, right? So owning commodities in a broader portfolio is encouraged as a hedge against inflation, right? So again, we're just talking about hedging your money. Again, diversifying, as we spoke about earlier, right? To simplify. All right, so that's kind of a broad overview of what a commodity is. Let's go into what exactly commodities trading is. Let me go back here. So let's take a look at what commodities trading is. Salute Ibmore Red Pill 81. How are you? So let's go to commodities trading overview. Make sure you can see this. It's still loading. There we go. All right. So we know what a commodity is. We're looking at what a commodities trading, we're going to look at an overview of what commodities trading is, right? Commodities are an important aspect of most Americans' daily life. A commodity is a basic good used in commerce that is interchangeable with other goods of the same type. So we spoke about that earlier, right? Traditional examples of commodities include grains, gold, beef, oil, and natural gas. So remember, it's not just metal. Things like grains, things like beef, things like oil, all of these things are commodities. So the commodities market is vast, right? When you think about all of the things that could be classed as commodity, it's quite vast, right? So for investors, commodities can be an important way to diversify their portfolios. Again, it goes that word diversify, as said by who said diversity? Stackmo. Diversify, again, the word's coming up again, right? So where am I? Diversify their portfolios. So it's always important to diversify your portfolio and not rely on one particular market or type of investment, right? their portfolios beyond traditional securities. Because the prices of commodities tend to move in opposition to stocks, here we go, oppositions to stocks, some investors also rely on commodities during periods of market volatility. So again, let me read that line again because it's very important. Because the prices of commodities tend to move in opposition to stocks, some investors also rely on commodities during periods of market volatility. So this goes back to what I said in the beginning, right? When the stock market is down, you tend to see commodities moving up. So rather than you sitting there twiddling your thumbs while the stock market is down, you'll often find that, the commodities market is moving in opposition to stocks, and the money has now moved to the commodities market, right? So again, this is why it's important to diversify between different markets and not get emotionally tied to stocks. Don't get emotionally tied to crypto. Don't get emotionally tied to commodities. Don't get emotionally tied to Forex, right? All of these things, are independent markets themselves. And generally, as I said, the money moves around between different markets, right? So again, the beginning of the year, we saw most stock markets were down, but we noticed that the commodities market started booming. We started seeing, the price of oil going up. We've seen the price of palladium going up. Various different other commodities were going up while the stock markets were down. And again, once you have the knowledge on how to trade commodities, you can then move over to those markets and start making money in those markets as well. So in the past, commodities trading required significant amounts of time, money, and expertise, and was primarily limited to professional traders. But today, there are more options for participating in the commodities market, right? So we're being told that today, there's major opportunities to be had in the commodities market, right? Commodities that are traded are typically sorted into 4 categories: broad categories: metal, energy, livestock, and meat, livestock. Let me read that again: metals, energy, livestock and meat, and agricultural. For investors, commodities can be an important way to diversify their portfolios beyond traditional securities. In the most basic sense, commodities are known to be risky investment proposition because their market, supply and demand, is impacted by uncertainties that are difficult or impossible to predict, such as unusual weather patterns, epidemics, and disasters, both natural and human-made. There are a number of ways to invest in commodities, such as futures, contracts, options, and exchange traded funds, also known as ETFs. Again, don't get confused by these terms of futures, contracts, options, and exchange traded funds. They're simply just vehicles that allow you to invest in these various investments. So in this case, it'd be commodities. So just different ways for you to invest in, copper, oil, grain, whatever, right? So again, going back to why we diversify, remember we said that, stocks over the long term traditionally give you the best return. Forex is the largest market, and commodities tend to work in opposition to stocks. That when the stock market is down, then the commodities market is generally up, or there's usually opportunities in there, right? So now we should have a decent fundamental understanding of what stocks are and what the stock market is and how the stock market works, what Forex is or foreign exchanges, how the Forex or foreign exchange market works, and also what commodities are and how the commodities market works. Let me check the chat to see if there's any questions. Statmo says, would that be XRP for crypto? I'm not sure exactly what you were referring to earlier. I know this was asked a little while ago. So I'm assuming you're talking about what the actual market was. So XRP essentially would be the equivalent of like Visa or MasterCard. They're basically the networks that allow money to exchange. So if you was referring to for I don't know. It's I don't know if there's a direct kind of correlation in that way. XRP just simply facilitates trading or the movement of money. Um, there isn't the markets don't necessarily facilitate the actual exchange of the money. They just kind of represent a kind of overall value. So I'm trying to answer your question based on what you were talking about. So it's not really a direct correlation. They said the direct correlation of XRP would be like Visa or MasterCard. It's like the Swift protocol, if you understand that. They say think or swim is too hard to understand. Is there an easier tool to use? What is think or swim? I'm not understanding I don't know what that is. If you give me a bit more information, then maybe I could understand what you're referring to when you're saying think or swim. I don't know. All right, so now we understand what these markets are. Let's take a look at some charts and get a foundation of what the charts are. All right, so let's go here and look at some charts, right? Make sure you guys can see this. Let me see, it's taking a little time to come up. I don't know if it's delaying on my side or your side, so there we go. All right, so this, for those who don't know, this is a trading platform, or I should say a charting platform called TradingView, right? So TradingView is essentially a platform that allows us to look at the value of various stocks, Forex, and commodities, right? So, yeah, this is essentially what it allows us to do, right? So let's start with the basics. All right. So let me bring up one of these screens. So essentially, what you're looking at here is the focus on investing trading template. All of these things are available at focusoninvesting.io. We also have custom coded indicators that we coded that help you to read the charts better, right? So here we're looking at the US dollar index futures. We're looking at various different time frames. So each one of these screens is looking at the price based on different time frames. So this chart is if I bring it closer, this is the 1M. If you see the 1M in the top, 1M means 1 month. And that basically means each one of these lines on the charts represents the value of US dollar index futures over 1 month. Here we're looking at the 1 week. So each one of these lines represents the value over 1 week. Here we're looking at the 1D, which stands for 1 day. And each one of these lines represents the value of a stock over 1 day. Let me go to the US dollar here. So this is the monthly of the, no, actually, let me go to an actual stock. Let's go to Microsoft. Pick a symbol MSFT. This is a company that you guys understand. So this is the stock of Microsoft Corporation. Everybody should understand what Microsoft is. They make computers, and well, they don't. Do they make computers? Well, they do now. They make hardware, but they're most famous for their Windows software. All right. So this chart, if I give you the chart along the bottom, you see time. It's a scale of time. So you can see 2006, 2008, 2010, etc. So as the chart moves from left to right, we're going forward in time. These numbers at the right-hand side of the screen are representing price. So we can see $0, $25, $50, $75. So they're representative of price. So these charts that we're looking at, it's basically a chart representing the value of the stock over a certain period of time, right? What this software also does, it also, excuse me, it also color codes each one of these bars. So again, each one of these lines are referred to as bars or candlesticks. So if you see, and again, these bars or candlesticks represent the price movement over the given period of time. So if we're looking at the 1 month, each one of these bars represents the movement of price over 1 month, right? So if we look at the green bars tell you if it was green, that means the price what exited the month higher than it entered into. And if we look at the red bars, we know that price exited the month lower than when it started, right? So this is how you differentiate between red and green bars. Let me see if I can do it on here actually. So to understand exactly what a bar is, let me see if I can get a bit of a blank. Yeah, we can do a bit of drawing, right? So we can understand that, you know, if we ever look at a live stock chart or a live stock market, we will see price, you know, goes up, it goes down, it does all basically various different manner of things, right? Of going up and down, right? So, you know, when you see that, it's hard for you to kind of make any kind of sense of exactly what that is, right? Or what that is actually doing. Let me see if I can show you a live version. Let me go here. Let's see. Show you a video of what it actually looks like. You know, if you watch some of these television programs, you will see how the market actually moves. Let's see if I can find one. I don't know if I can find an example straight away. Let me see if I can. No. But essentially, if you look at a stock market, you will see it continuously flicking up and down, up and down, up and down, right? So when it flickers up and down like that, it's hard for you to basically make any kind of understanding or make any kind of plans to it. So essentially what you're looking at when you're looking at the charts, you're looking at, let me draw. You're looking at basically it broken down into segments. So say for instance, this is, you know, price over a week, or let's say for a certain amount of time. What you're looking at with those bars, you're basically looking at, you know, that it's breaking down into segments of time. So in the 1 month, let's just say for instance, you know, all these little sections here are months, right? And essentially what you're looking at is you're looking at price, the value that price entered into. So in this case, you'll see that price entered in, this is not looking coming out. If we, let me zoom in a bit, it might be a bit easier for you guys to see. Let me do that. So if we zoom in a bit more. No. So here we're essentially seeing the value that price entered in that. the price that it had its highest point. All right, let's draw it here. It might be easier to understand. If we draw the month as being here, and let's say, for instance, we're going to take this slice here as 1 month, right? So if we look here, we can see the value that price entered in at the start of the month. Here you would see the value that price reached its highest point. Here you would see the value that price reached its lowest point. And then let me flip the arrow. You can see here the value that price left at the end of the month, right? So if we're saying this span between this blue line here, let me draw it for you. Saying this blue line here is the start of the month, and this blue line here is the end of the month. We're seeing the information of it entered. You know, the company did well for a while. The value of the company went up, therefore the value of the stock went up. The value of the company went down for a while, therefore the value of the stock went down. And then before the end of the month, it rose again, right? So this is representative of it over a whole chart, right? But you know, how do you make sense of that in a quick view of looking at it? So how that is done via bars, right? So a bar would be, let me use a different color. Allow me to use different color. Where are we? When I draw, okay, so if this is our entry price, we would draw our line here to represent our entry price. Let me use, what color can I use? Let me use, what color is a good color to use? Let me use blue. I'll use blue. No, that's confusing because we've already got a blue. Let me use a orange. That might be a bit better. I don't want to use red because we've got a red line. So this would be our entry price, right? Representing our highest price, we would draw a line here that would represent our highest price. Let me increase the thickness so you guys can see. That's our highest price. It's our entry price. Our lowest price is here. So we would draw the line all the way down to represent this is where our lowest price went down to. And then we exited at the end of the month here, right? So this is our entry for the month, our highest price for the month, lowest price for the month, and our exit, right? So if we remove everything to make it a lot clearer, let me remove all of this. And you will see exactly what the bars are telling you, right? So let me remove all of these. Oop. I deleted the entry price by accident. So our entry price was like here, right? Right. So if you see this is the entry price. This is the high point. This is the low point, and this is our exit price. So essentially, what a bar is, or what a candlestick is if we were to box off our entry price, we take it all the way across the bar. Let's make it a red, as this would be a bearish candle. We box down to our exit price, and then we box back up again. So this, and let me overdraw this to be red. So whenever you're looking at a bar or a candlestick, this is essentially what you're looking at. This is the information it tells you. Where's the can draw a rectangle here. So, and again, remember, if it's a red bar or red candlestick, that means the entry price exited lower than it entered in. And if it's green, that means it exited higher than it entered at the beginning of the month. So let's just turn that red. All right, so this is what we're looking at whenever you see each one of these bars or candlesticks, right? This point, let me draw it here. Where am I? Here, also here. So this here, this big square, we refer to that as the body. And this line at the top and the bottom, we refer to as a wick. So, you know, in a candle, you have the body of the candle and you have the wick of the candle. This is what we refer to as the body and the wick of the candle. So the wick tells you what the highest point was in that time frame. So in our case, it's the month. And the bottom of the wick tells you what the lowest time frame, oh, sorry, let me say that again. The wick tells you what the highest price within the time frame was. So in our case, it would be the month. So the highest point in the month is where the highest wick was. And the bottom of the wick tells you what the lowest price was in that given time frame. So in our example, in the 1 month, so within that 1 month, that bottom of the wick tells you what the lowest price would be. So in our example here, even though I've just drawn it randomly, I draw a line at the top. You see it was 662.42, and the lowest point was 601.77. So, you know, $662.42 and $601.77. So that would be our example, right? Then if we go to the body, remember the top of the body is what price entered into in that given time frame. So in our example, it'd be in the month. So the price entered in the month here, which would have been $644.23. And the bottom of the bar or the candlestick is the price that that the value that price exited in for the end of the month. In our case, it would be $611.41, right? So this is the information that the candlesticks or bars are giving you, right? So let me clear this. So now when we look at the overall stock market and the stock chart, we can see for this month, we can see, let me zoom in even closer so you guys can see. So we can see our wick here. So the top of the wick is here at $314.57. So we know, again, if we check our intersection of time and price, we can see that this is representing, because we're in a monthly time frame, the 1st of April, which is so we're actually starting a new bar today, right? So this is for last month. So we can see the value of last month. So in the month of April, which this whole bar represents the price movement on April, we can see that the highest price point in April was $314.57. We can see that the lowest price for Microsoft in that month was $270.22. We can see that the value of the Microsoft stock at the beginning of April, the beginning of the month, was $309.27. And we can see that the price that the stock exited the market was $277.52. Now, remember, I'm drawing lines here roughly, so it might be slightly different. But if you ever want to know the exact price, what it was, there's a window here on TradingView called the data window, which is the 4th window down. And it will tell you the value of any one of these bars, right? So if we hover over this bar for April, we can see the exact price. If I click on it, so we can see, you know, the data window is telling us the date, which is the 1st of April. As this is the monthly chart, it's basically representing the whole of April. We can see that the open price, or the price that it started the month, was $309.37. The highest price in the month was $315.11. The lowest price in the month was $270 flat. The close price was $277.52, and also tells you, you know, the change, minus 9.9%. It was a minus $30.79, right? So this is how you read the charts and you understand the chart. So again, all of this is a representation of the value of the stock of the company, and the stock of the company represents the overall value of the company, right? So now you've got a basic foundation of exactly what we're doing when we're trading stocks, forex, and commodities. Okay, let me go and show you some the forex charts as well. So let's go to USD GBP. So this is the where are we? Oh, let's go USD against the euro. So this is the US dollar against the euro, right? So this is a forex chart, right, that we're seeing. Now notice that the forex charts tend to have a lot more volatility, right? There's not such clean sweeps upwards and downwards. Why? This is because, you know, these are pairs pairing off against each other, right? So this is not representing an individual value of each one of either the dollar or the euro. It's representing the difference in the value between the two of them, right? So we can see that US dollar is 0.9479 of the euro, right? So that's it's essentially what it's telling you. It's a similar chart with the time along the bottom and the price along the side. And each one of these charts is representing the difference between the two of them. Obviously, if we reach the one, which is here, let me see if I can hit one exactly. It's 1 0. Okay, let me do a one. We hit this one. Yeah, one. There we go. So if we're hitting one, that means you would get exactly $1 US for €1, right? So currently what we're saying is you will get 0.94 US dollars for a euro, right? So this is what this chart is telling you. Again, it's the exchange rate between the two different currencies, right? And again, the green bars are representing, you know, price exited higher than it entered for the month, and the red bars are represented price exited lower than it entered into the month, right? So again, each one of these bars or candlesticks are representing price movement over that given time frame, and in our example it's the monthly time frame. So this is representing the price movement over a month, right? So yeah, so essentially when we trade, we're trading on the movement of the difference between the two currencies. All right, let's take a look at a commodity. Let's look at US oil or crude oil. So this is representing what the value of oil is, again, over a certain time frame. So again, we're in a monthly time frame, same chart. You can see that the time is along the bottom and the monetary value is along the side. And again, this is representing the value of oil over per month, over the years, basically. So again, each one of these bars represents the value of oil over that any given month. Again, the green bars or green candlesticks representing that price closed higher than it opened. And the red bars or red candlesticks are representing that price closed lower than it opened, right? So again, this is between the red and the green bars, and it's just showing you, indicating movement over those time frames, right? So this is why I say, you know, there's no need to stick to particularly the stock market, particularly, oh, let's go to, just check again, BTC. Let's check Bitcoin. Bitcoin looks exactly the same thing, right? Time across the bottom, and we can see price along the side. Similar thing, this chart is representing the value of Bitcoin over a certain given amount of time. Again, we're on the monthly time frame. So each one of these bars or candlesticks represents the value of Bitcoin over that month. So again, if it's a green bar, that means that the value of Bitcoin closed higher than when it opened. And if it's a red bar, it means the value of Bitcoin closed lower than when it opened, right? So again, this is just showing you the price is represented on a chart over a certain period of time, right? And the benefit of utilizing the chart in order to make your trades is because, this is tangible evidence. This is not guessing. I'm not telling you I guess the price of Bitcoin. I'm not telling you I guess what the price was on the 1st of February or any of these things. This is giving me actual chart, actual solid, hard, tangible information in order for me to be able to place my trades, right? So now we have an understanding of exactly what charts are and what they represent and how you utilize them. Let me go back to Microsoft. Let me check the chat, see if there's any questions. Celia says, do you use MT4 to trade? I previously have used MT4 or MTX to trade Forex in the past, but currently I don't use NT4 to trade. No, I don't currently, but I have done in the past. When I was strictly doing Forex trading, I used to only use MT4 to trade. But I don't utilize that at the moment. I actually use a different broker at the moment. All right. All right. So now we understand what the markets are and what they represent. Okay. Let me go back to my chart. Okay. So again, how do you make money in the markets? In any market, whether it's crypto, Forex, stock, or commodities markets, right? Let me go to the daily. I actually have a filter on this, so let me remove my filter. All right, so essentially all trading on the markets is what they call speculation, or I don't like to use this word because it's not accurate to what we're doing, but it's essentially gambling or guessing, right? You're gambling or guessing the direction of the stock, right? Or whatever asset you're trading. So for simplification, we're going to say stocks because we're in the stock market, right? We are guessing or betting that either the price might go up or down, right? So if we think the price is going to go up, that means we're going to buy a stock or we're going to go long. And if we think the stock is going to go down, that means we're going to sell the stock or go short, right? So essentially what we do is we place a bet with the broker, and we place a bet with the broker to say to the broker, we bet that the stock will go up. And if we put money on that stock or buy the stock and it goes up, we earn money because it's gone up. We guess correctly. However, if we bet for it to go up and the stock went down, therefore we would lose money because we bet incorrectly, right? And vice versa. If we bet for it to go down and it went up, we would lose money. If we bet for it to go down and it went down, we would win money, right? So we place our trade through a broker because, as we said previously, it's the broker that are brokering deals between those that are betting for it to go up and those for it to go down, right? So it's like any sort of bookmaker or any kind of betting, whether you bet on sports, the horse racing, you play football or soccer, depending on how you want to say it, any sort of sport you want to bet on, you go to your local bookmaker and you bet, I think my team is going to win, I think this team is going to lose. It's the same difference, right? The bookmaker is brokering a deal between those who believe the person is going to win or the team is going to win and those that are going to lose. It's no difference here, right? You're essentially placing a bet as to whether it will go up and down. Now, exactly how that is done, again, this is going back to, instruments or vehicles. There are various different vehicles to determine how price moves up and price moves down, right? So to give a quick example of different ways you can go up and down. So say, for instance, Microsoft. We want to make money from Microsoft going up, right? So one way you could do it is you could go and actually physically buy stock of Microsoft, right? So let's say, for instance, stock of Microsoft is worth $100, right? You could physically go and buy physical Microsoft stock. You hold on to it for a month. At the end of the month, the price is increased to $200. Therefore, you bought something for $100. It's now worth $200, and you've made $100 in profit, right? So that would be you outright buying the stock from Microsoft, right? It's pretty simple to understand because we can understand because it's tangible, right? Versus, say, for instance, you wanted to do spread betting, which is a type of instrument or a type of vehicle in order for you to trade Microsoft. Now, when you do spread betting or any sort of other kind of what they call derivative, again, this is another one of these words that might trip people up. But when you say derivative, all the word derivative means is that it derives from something or it comes from something, right? So when we're talking about derivatives in terms of trading, you're generally talking about an instrument that derives its value from something else, right? So when we're talking about spread betting being a derivative of Microsoft, we're talking about you don't actually have to buy Microsoft stock, but the value of whatever you're trading derives its value from the Microsoft stock, right? So generally it means the price or the value is correlated with that same thing, right? So it's almost like a stock is a derivative of the value of the company, right? So the value of a stock is derived from the actual value of the company. As the company does better, the value of the stock increases because it's deriving its value from the company. As the company does worse, the value of the stock is worse because it derives its value from the company again. So a derivative just means it derives its value from something, right? So again, a derivative is not you buying the actual stock, you're buying an instrument that represents the value of that stock, right? So as we said in our first example, you just simply buying the stock. Whereas if you're doing something like a spread betting, you're essentially betting with the broker that the value of the stock will go up 100 points, right? So, and again, each instrument works differently. So if we're doing spread betting, if I bet that the value of the stock will go up by $100, let's say, for instance, I bet the broker $1 per each dollar that the value of the stock goes up, right? So if I made the size of my trade $1, that means I'm agreeing with the broker that for every dollar that the stock goes up, I will receive $1 in return. So in our example, if it goes up $100, we would receive back $100 because it moved back $100. Again, that's just an example. Generally, it's not done in increments of $1, like how the return is valued, right? But equally, I could say I want $10 for each dollar that the stock goes up again. So now we're talking about leveraging value, right? So this is what the ability of instruments allow you to do, right? Instruments allow you to leverage the value of a stock, right? So whereas if you just simply buy the stock, you can only make back the return how much the stock went up, right? So if it went up by $100, you can only make $100 on that stock. Whereas if you use a derivative or some kind of instrument, you can leverage the value by saying, rather than just giving me the $1 as it goes up, I'm going to bet $10 for each dollar that it goes up. So every time the actual stock goes up $1, you receive $10 in return, right? So these are two different ways of trading Microsoft stock, one with the original stock and one with the derivative. Conversely, you can make money when the stock goes down, right? So I can also bet $10 for every dollar that the stock goes down. So if it started off at $200 and it went down to $100, then for each movement of that $100, I can make again $10 on the movement for each dollar that it went down. Similarly, if I'd have said $1 or whatever amount you wanted to do that. Now, conversely, if you wanted to buy the stock, you can make money from shorting. Now, shorting is a whole thing in itself. A lot of people get confused. How can you make money from something losing value or going down? And I could do a whole session on what shorting is, because a lot of people don't really understand or grasp what shorting is. But essentially, shorting is borrowing and buying back. Okay, so let's say, for instance, I don't own any Microsoft stock, and let's just use a fictional person. Let's say Warren Buffett owns Microsoft stock, right? So I go to Warren, and the stock is at $200. I believe by tomorrow it's going to be $100. So what I will do is I will borrow the stock of $200, a Microsoft stock for $200 from Warren, and I will sell it at that time. Now, when you borrow the stock, you pay a fee on top of that to borrow it from him. So let me hold it for a day, Warren, and I'll give you a rental fee. Let me give you a fee just to hold it for a day, right? So I've got this $200 stock from Warren Buffett of Microsoft. What I would do is instantly sell it at $200, right? So now I have no Microsoft stock and I have $200, right? But what I think is that tomorrow the Microsoft stock will be worth $100. So time plays out, and then tomorrow comes, and lo and behold, Microsoft stock has dropped to $100, right? Now that Microsoft stock has dropped to the value of $100, I will take my $200, take $100 of that $200 and buy back the stock, right? So now I have Microsoft stock plus the remaining $100 that I had from my $200, right? So now I'm in a position where I have $100 and Microsoft stock that's also worth $100. So essentially $200 again, right? I will then go back to Warren and give him back his Microsoft stock. He's happy because he's restored back into the position he was in the first place. Plus, he's earned a little money from, loaning me that stock. And me, I've made $100 that I didn't have in the beginning, minus the little fee that I paid Warren Buffett, right? So in that instance, I've made money from the value of the stock going down, right? So this is, again, a different instrument or a different vehicle for you to make money when stocks go down. Now, remember, there's different instruments. There's, as I said, there's spread betting, there's contract for difference or CFDs, there's ETF, exchange traded funds, there's options, there's futures. They're all different type of instruments, and they're all different creative ways for you to be able to make money, right? And essentially, they're all doing the same thing, giving you an opportunity to bet or speculate the price will go up or go down, and a way of rewarding you if the price is correct, right? So Luciana says, is your trading view indicator available in the US? Absolutely. If you go to focusoninvesting.io, the URL is at the bottom of the screen. You can get access to all of our custom coded indicators. We have a range of custom coded indicators on our screens at the moment. Let me just go through them just to show you. And I'm gonna bring this one back. So we have a range of moving averages, pointing out key resistance and support levels. This is our pivot indicator. We also have a trend filter. If you notice that, if I turn the filter off, you will see that we have red and green bars all over the place. Sometimes it's hard to understand or make out what exactly price is doing with all of these red and green bars over the place. But once we put on our focus on investing trend filter, we can see it simplified for us. If it's bullish or going well, it's green, and if it's bearish, it goes red, and it means it's not doing so well, right? So these things help us to see instantly what price is doing, right? This is another important thing, is being able to, once you train yourself and learn how to utilize the charts, you want to be able to look at a chart instantly and be able to tell whether it's a good investment or a bad investment, right? So indicators help us to do this. It also gives us, points on the chart for us to, compare with, right? If the human brain works by comparison, we never look at things in isolation. It's always something in relativity, right? So our indicators allow us to perceive things in relativity to know if something is doing relatively well or relatively bad, right? So this is what the indicators allow us to do on our charts and on our screens. They give us a reference point for us to understand whether price is doing good or price is doing bad. And it also gives us hard points or distinct things for us to know whether or not, we should be investing or not. So again, I speak about technical analysis because technical analysis is about, should you invest, yes or no? Not maybe, not I heard, not I think, maybe not I believe, not because somebody told me. It's, you need a solid checklist. Does this asset meet our checklist, right? And it's very easy for me to show. So let me ask the chat this, something very simple. If we look at this Microsoft stock currently, is the trend filter on our current day? This is our current day. This is the 29th of April. Remember, the stock markets are not open on weekends, so this is representing the 29th of April. On the day of the 29th of April, very simple question, is our trend filter green or is our trend filter red? Let me ask the chat. It's a very simple question, but no problem, Luciana. But yeah, is our trend filter green or is it red on the 29th of April? Very simple question for the chat. Let me see the chat answer the question. On the 29th of April, was the trend filter green or red? Let me draw an arrow for you guys so you know exactly what bar we're talking about. This bar here, on the 29th of April, is the trend filter green or red? Let me see your answers in the chat. I know it sounds like a silly question. It's a simple question. So again, we see Stun Legacy, excuse me, says red. Stackmo says red. Celia says red. Right, very simple. I'm not telling you, do you think that this stock is going to, or is your auntie said, again, Luciana says bearish, again, representing red. It's no guessing, it's no and ahhing. This is based on numbers, mathematical figures. Like, you can easily calculate that that is red. There is numbers, it's tangible, it's no guessing, it's no believing. There's no, because I said so, just because Focus said so, it doesn't mean you should believe it, right? This is tangible, what we could all tangibly see, right? So imagine if you had a checklist that gave you a list of things to check that just tells you directly whether you should invest or not. If the trend filter is red and it tells you don't invest if it's red, it's red, we don't invest. Conversely, if it said to you, if say this was today's bar, let's get in our DeLorean, where are we? Let's Marty McFly Back to the Future. We go Back to the Future. If we say if today's bar is green, you can invest. We can clearly see that today's bar would be green and then we could invest, right? This is very clear. It's very simple. This is all based on numbers and mathematics, calculations on the charts. It's no guessing. I'm not telling you to guess. I'm not telling you that I heard that Microsoft stock is going to. It's not, oh, they're just about to release a product and I think that that product is going to do none of this business. This is why we deal with technical analysis. Technical analysis deals with trading the charts, trading exactly tangibly what you can see on the charts, right? So we even have, we even have a if we go to our final, so again, this is our focus on investing template. We have 4 screens as our 4 screen setup, and each one of these screens have different indicators on. If you notice, as different lines representing different things. So this is the monthly time frame, has a different set of indicators on. We have a set of indicators if I refresh the screen. For the weekly time frame, you know, we have different sets of lines here. Each one of these represents different things and different values. And again, each one of these indicators represents a checkpoint on our checklist. If we look at our first daily time frame, we see certain amount of indicators again, which is different. Let me put back my, do I have my trend filter? Yeah, we've got trend filter on. And then on our last daily time frame, we have an indicator, which is a really powerful one as well. This one here tells us exactly what candlestick or bar to enter into. So if you look here, this is our buoy or our BRI or our breakout indicator. If we look here, we can see this. If I zoom in for you, if we look at this green bar here, we can see that we've got our BRI or our breakout indicator underneath it. It's this little green dot sort of symbol below our green bar, green indicator. This is telling you exactly what bar to enter into if you want to enter into a long or a bullish trade. Conversely, we see we've got a red BOI or red breakout indicator. This tells you, you know, this is a great bar to enter into if you want to enter into a bearish trade, right? So these things are very simple, right? There's no guessing involved. There's no nothing. And all of these indicators are plotted on the screen based on mathematical formulas, right? So there is something in price which is indicating that this is a good bar to enter into, right? This is not guessing. This is not guesswork. This is why we use technical analysis, and this is why we use these platforms, and this is why we code these indicators. These indicators are coded because they're based on mathematical principles. Based on what price is actually doing, it will determine whether the chart will plot these symbols or not, right? So could you do it without the indicators? Of course. You could get out your ruler and start measuring and start calculating the difference between all of these bars and where we are positionally. But who wants to do that, right? When you can instantly see there's a green dot underneath here, there's a breakout indicator. This is a good bar to enter into. This is a good bar to enter into, right? So when we're dealing with, you know, focus on investing in our trading strategy or trading plan, you know, I always look at good trading strategies like, you know, I always use the analogy of, I don't know if you've ever heard of the show called I think it's called Flight Investigations. Air Traffic Investigations. I'm messing up the name now, but essentially it's a show. I think it usually come on Discovery Channel or something like that, or maybe History Channel, one of those. But essentially it talks about, you know, whenever a plane crashes, air crash investigation. That's what it's called. I think it's called air crash investigations, right? It basically talks about, you know, whenever a plane crashes, they go back and they look at what caused plane crashes, right? And you know, planes are really quite safe vehicles when we look at them, right? And you know, for a plane to crash, something drastically has to go wrong. And generally, what you find is in plane crashes, it's not one thing that goes wrong, right? It's generally a number of things. So it might be that, you know, it was an old plane, the plane was due for servicing, the plane didn't get serviced because the person who was supposed to do it called in sick and it got overlooked. You know, the indicator light on the plane wasn't working. You know, there's usually a number of things that cause it to fail, right? It's never one thing that happens, right? And you know, this is how we approach our trading strategy, right? When you look at the stock market or any other type of market is essentially the wild, wild west, right? It's going up, it's going down, it can move any direction. You know, you know, you can't really predict which way it's going to go, right? So how do you then gain control of something that is wild? And me referring to it like the wild wild west is like real countries, right? In real life, the real wild wild west, you had a load of people that moved there. It was lawless. People were doing whatever, right? So how do you start to gain control of something that's wild? Well, you start implementing rules and laws to abide by, right? And those who follow the law are allowed to have freedom and allowed to pass, and those who don't follow the law get locked up and they get taken out of society. So essentially what we do a similar thing with trading, right? We create what we call a HPE, or a high probability environment, right? So anybody that can tell you they can predict the exact price of a stock is lying to you. I'm telling you that from now. Nobody can predict the exact value of a stock, right? So what you can do is you can create a high probability environment. So we don't know exactly, but it's highly probable that the stock is going to go either up, down, or sideways, right? So we're creating environments where we can basically guess the direction of the stock, and we can then know which way to bet the stock, right? So we call these high probability environments. Well, how do you create a high probability environment? Well, this is based on basically the different parameters that you apply to your trading, right? So let's say, for instance, we go back to our trend filter as the example, right? The trend filter is a mathematical calculation showing either green or red based on a certain value of the stock, right? We can easily eliminate those that don't follow our rules, right? If it's not a green stock, then we take it off of our list. It's not something that we consider passing our checklist. It's like quality control. You produce any sort of product, it goes through a number of checks to make sure it passes the quality control in order to pass through to the next round. So essentially what we do with our strategy is we create a situation where we have a certain level of a high mark. It has to pass a certain quality in order to get into our high probability environment, right? So we have a numerous different indicators and different parameters that it has to pass in order to make it to a high probability environment. And what you find is at the end of all of the checks in the checklist is that you find that if this particular stock has passed all of our parameters, then there's a high probability that this stock is going to do well and go in a bullish direction, or it's going to go down and go in a bearish direction. And that is what allows us to essentially place our trades and know whether it's going to do well or do poorly, because we have all of these indicators based on mathematical calculations that will tell us, the history of the stock, how the stock is currently performing, and what it's likely to do in the future, right? So this is how we do it. And then again, it's not just this that we do. We also have risk management strategies, right? So we have a situation where we've got a certain strategy where, let's say, for instance, you entered into 5 trades. You could lose 4 trades, win 1 trade, and still be in profit, right? And this is the importance of having a good risk management strategy. It's not just about what you see on the charts and guessing which way it's going to go. You're talking about having risk management. So not only do you make money, but you also protect your investment, right? A lot of people have fear of getting into the market because they might lose your money. If you don't have proper risk management strategies, you will lose it. However, if you trade correctly, you have risk management strategies that will stop you from losing your money, correct? Right? The other thing we do is we do leverage. We have a way that once you have a winning trade, you can double, triple, even quadruple your returns in your money. So not only are we talking about leveraging when we use instruments to, instead of getting $1 for each dollar that the stock increases or decreases, we talked about leveraging maybe $10 per each dollar that it moves. There's also other setups we can do so we can leverage our leverage. So we're leveraging leverage, if that makes sense. So to the point where we can now double our movement of this stock. So each time it moves, we double whatever we put down, tripled, quadrupled what we put down, right? So these are all of the different elements that go into investing into stocks, right? So we have a question here from Celia. It says, why did you say trend filter instead of candle? So our trend filter is an indicator that we have, right? So for instance, these are 2 daily time frames. So if you look at our daily time frames, we can see that they're green and red candles back to back. But our trend filter filters out the noise of the green and red. And if you notice, that, we have it in blocks, either all green or all red or all green. So this is basically telling you, whether the stock is doing well or the stock is doing poorly, right? So we applied a filter over the top of all of our candlesticks. If I remove the filter, you will see that we're going to have red and green back to back. If I remove it, you can see that all of these bars or candlesticks are red and green, representing bullish or bearish candlesticks. However, each individual candlestick is not necessarily of interest to us when we're looking at this screen. So we apply our custom coded filter that gives us a basic overall information of what this collection of candlesticks are doing. So the filter is placed over the top of the candlestick. So that's to differentiate the difference. We've filtered out, all of the noise between each one of them, and it gives us an overall reading to give us a better information as to what the candlestick is doing. All right, so we're coming to the end of our 2-hour session. Are there any questions before we sign off? So I hope I've given you guys a good understanding of exactly what stocks are, what Forex is, and what commodities are, how they're traded on a market. This is, trading view, how we see what the value of all of these things are and how we read and understand the value of these things, how we make money from the movement of those things, what the indicators do and allow us to understand the value of these things, and also, what other precautions and things we can do to protect our money and also leverage our money, right? As I said, this is our 4-screen setup. This is a custom, this is our template for focus on investing. You can also see many different filters on each one of these, many different indicators on each one of these screens. We have 2 on this one, 4 on this one, 5 on this one, 4 on these ones. And this goes to compile our overall trading strategy that allows us to win in these markets, right? This gives us a high probability environment that allows us, high probability of picking, the correct stocks. And when we do that, we also combine it with our risk management that prevents us from, losing our money. And then we use our leveraging abilities as well, a leveraging strategy to increase the money that we do generate from these markets, right? So the whole idea is that we make this money and we make it consistently, right? When you have a trading strategy, your trading strategy, once it's like a checklist, as I said before, it gives you consistency. The consistency over time is what allows you to, make a steady income continuously coming in, right? So at the end of the day, we want this to become a steady income for us. We want it to become, ideally a primary income for you. And then this is how you start exchanging, stop exchanging your time for money. Most of us go to work, we exchange our time for money. We get paid a certain amount per hour. What is the issue with that? The issue with exchanging your time for money is that there's only 24 hours in a day. So the amount of money you can get back is limited to times 24, right? Not only that, you have to exchange your most valuable currency, which is time, right? What trading allows us to do, we can run through, when we have our indicators and we have our checklist, we can run through stocks, and just do 20 minutes a day. Trading only takes 20 minutes a day, right? Once you understand how to look at a chart, you can instantly see whether a chart is worth investing in or not. Again, 20 minutes a day. You do your work for 20 minutes and you're getting paid what most people get salary for a year, and you're only working 20 minutes a day. Therefore, you have the rest of your time to, do whatever you want to do. Enjoy life as we like. If you like traveling, you want to spend time with your loved ones, you want to, if you like exercise, whatever it is you would like doing, you can do that because now you freed up your time and increased your money at the same time. So this is how you end up with financial freedom, right? So if you guys want to learn, the full strategy of how to invest into stocks and our focus on investing strategy, also get access to all of our templates that we have, also get access to our custom coded indicators, You can also get access to our stock list. So we give you weekly stock lists of all of the best stocks. And then we even have, our Patreon, private group that, we can talk more in depth about strategies and specifics about, exactly how to do specific, strategies and things like that. We do that on there with our live streams on our private, sessions. We also have what we call premium trades, where we literally tell you exactly what stock to invest in and what price to invest in it. So you don't have to do any sort of, analysis or, strategy. So we encourage that if you want to make money straight away while you're learning how to trade into stocks, you can make money at the same time that you're learning. By just, as I said, by me just basically giving the stocks to invest in, and you can start making a return on your money straight away. If that sounds like something you would like to do, if you'd like to, buy your freedom, as Luciana said, you say, heck yeah, trying to buy my freedom. Well, you can pay for your own freedom with stocks. Then go to focusoninvesting.io. If you would like to support me and support these streams that I do, the Cash App is at the bottom of your screen. It's Cash App, British pound sign, focus on investing. Salute to the Cash App that I received last week. I received it after the show had finished, so I don't want to say the name because it might be the government name. I don't want to give your government out on the stream, but salute to you for giving me the Cash App that was given just after we finished the stream. So that's very much appreciated. Again, your Cash App helps me to do these shows. Again, I don't get paid for these shows. I just give this information to help you guys get a better understanding of how trading works. So if there's something you would like to do and support the stream, you can support by giving me a Cash App. All right, ladies and gentlemen, brothers and sisters, that comes to our end of our 2-hour mark. I hope you found this session very informative and interesting. Remember, we're here every Sunday to take any of your questions about, trading stocks, Forex, or commodities, technical analysis, anything you have about reading the charts, and any other kind of questions you have around understanding trading and making money in investing. All right, again, we're here. GMT time is 8 p.m. I think Eastern Standard Time is 3 p.m. And as far as I'm aware, Pacific Time is 12 p.m. Every Sunday we do this. All right, ladies and gentlemen. So thank you very much for joining me for this session. And I hope you have a great week. Take care. Peace. Before I go, don't forget, if you haven't done so already, hit the like button and hit the subscribe button if you can. All right, take care. Peace.